This is education and entertainment, not financial advice. You still own your trades, your taxes, and yeah, your margin calls. Do your own research. Now, is NIO profitable yet, 2026? That's the headline everyone's throwing around. So here's one for the hardcore crowd. Which year did NIO's US-listed shares hit their all-time peak back in the last cycle? And roughly what price range did they spike into? 20s, 40s, or 60s? Sit with that and stick around to the end for the answer and why that little history lesson matters for today's profit story.
I love that you open with, you own your margin calls. Like that's not going to trigger at least 3 people on this commute. I'm Simon, that's Layla, and the question on the thumbnail is exactly what we're tackling. Is NIO profitable yet 2026? The short version is, NIO's 2025 profit alert and first adjusted operating profit sound great until you read the footnotes and realize GAAP is still that X who keeps showing up with receipts.
On the surface, you've got the story. Adjusted operating profit positive, non-auto lines turning profitable, vehicle margins recovering, management hinting at a shot at full-year non-GAAP profitability around 2026 if volume cooperates. But underneath, GAAP operating losses, real cash burn, and a capital base so heavy it probably needs its own gym membership.
Right now, most of the "we're almost there" narrative lives in adjusted numbers. You strip out stock-based comp, some one-offs, maybe reclassify a few things, squint a little, and you can see a path to non-GAAP operating profit if 2025-2026 volumes and pricing don't fall apart. But GAAP is still dragging through depreciation on factories and swap stations, interest, and ongoing R&D. And free cash flow? That's still more aspiration board than line item.
Let's talk mix, because that's quietly steering a lot of this. You've got 3 layers feeding into 2025-2026. The NIO flagship brand at the premium end, Onvo trying to hit that family mass premium sweet spot, and Firefly nudging towards smaller, more affordable urban EVs. If Onvo and Firefly ramp, you get volume and better utilization in plants and the swap network. But every step down the price ladder pulls average selling price with it. Growth feels good until you realize it showed up wearing budget margins.
Newer models help though. The latest NIO platform, cheaper battery chemistries, and component cost downs have been nudging vehicle gross margin back up from those brutal price war lows. You can see the pattern. Every time an older, expensive-to-build model gets swapped out for a more efficient one, the gross margin mix quietly improves. The question is whether that climb outruns the drag from everything else on the P&L.
Because battery swap and energy are the other half of that mix story. On a segment basis, some of the energy and services lines are finally flirting with profitability as utilization improves. But that network is infrastructure. Stations, batteries, IT backbone, field ops. Those checks clear every month, whether you do 10 swaps a day or 50. Until enough cars are in the ecosystem, the profitable non-auto business headline is swimming in a pool of fixed costs that don't care about your slide deck.
And then we get to the part the headlines never bother to translate. Adjusted versus unadjusted operating margin. All the working capital gymnastics and good old subsidies. When management says, we achieved an adjusted operating margin of X, you want to know, okay, what did you adjust? Stock comp? Fine. But are we excluding fair value changes, restructuring, government grants? How big is the gap between GAAP and non-GAAP? And is it shrinking, or are we just moving furniture around the same room?
Working capital is where it gets spicy for the spreadsheet crowd. You can make a quarter look cleaner if you stretch payables, run down inventory, or pull forward some receivables. That's standard business, not fraud. But if profit only shows up when you lean hard on working capital swings, that's not a margin, it's a magic trick. Watch operating cash flow after those swings, not just the pretty operating income line.
Subsidies and tax incentives are the quiet co-stars here. Local support, purchase incentives, tax breaks, favorable land terms, they've all helped NIO's economics at different times. As those fade or normalize into the background, The underlying cost structure has to actually stand on its own. If your 2025-2026 profit alert depends on temporary policy boosts plus aggressive adjustments, that's less structural turnaround and more, we caught a good weather window.
So, for Chapter 1, here's the grown-up read on Is NIO Profitable Yet 2026? On the adjusted, non-GAAP headline level, NIO has a credible shot at posting positive operating profit if volumes scale, the new brands don't nuke pricing, and swap utilization keeps climbing. But under GAAP, with depreciation, interest, R&D, and real cash going out the door, it's still fragile. If you only read the alert and not the filing, you're basically trading the caption, not the balance sheet.
All right, Chapter 2. This is where we pop the hood on the stuff that actually decides whether 2026 is an inflection or just an especially well-worded shareholder letter.
Translation. This is where your inner analyst pauses the episode, opens the filings, and starts highlighting footnotes like it's a kink. No judgment. We're right there with you.
Let's start with the battery swap and energy network. Think of it as a fixed-cost monster with a variable-cost kitten riding on its back. Land or leases, station hardware, battery pools, back-end software, local ops teams, that's all fixed. Electricity and incremental labor scale with usage. Once a station passes a certain swaps per day threshold, contribution margin can turn positive surprisingly fast. Below that, you're paying rent on a very smart, very bored robot.
And the direction this goes decides whether swap is an asset or an albatross. Scenario 1. Onvo and Firefly pump a ton of cars into the ecosystem. Utilization climbs, and the network looks like real infrastructure with solid unit economics. Scenario 2. Growth underdelivers or competitors eat share, stations stay underused, and you end up with a beautiful, loss-making monument to over-optimism on every highway.
Next lever, software and services monetization. Things like advanced driving feature subscriptions, premium connectivity, maybe bundled energy plans. The margin profile, if they really scale it, is way better than bending metal. But right now, those lines are still a modest slice of total revenue. Any 2026 model that magically fixes profitability by doubling software income with no evidence is just very creative fan fiction.
You want to impress me? Don't tell me software will be huge. Show me attach rates on new deliveries, renewal behavior, actual ARPU, how much is recurring versus one-time unlocks, and how aggressively they discount those features to drive adoption. Until then, it's potential, not a profit center.
Partnerships and JVs are another under-the-radar piece. NIO has leaned on strategic capital and local partners for manufacturing, battery assets, and financing channels. That can de-risk survival and speed rollout, but it also creates dependencies. If one key supplier, funding channel, or policy-linked partner wobbles, it ripples straight into capacity, costs, and even delivery pace.
Regional expansion is the same story. Pushing deeper into Europe or other markets gives NIO optionality beyond China's price war, but it's not free. Service centers, local teams, compliance work, maybe localized incentives. That's CapEx plus OpEx before you've proven real scale. If international volume ramps, it diversifies risk and helps utilization. If it stalls, congratulations, you've just exported your fixed cost problem.
Then there's financing and incentive alignment. NIO's mix of state-linked, strategic, and market funding influences behavior. If management scorecards are still heavy on deliveries and market share, expect growth-first decisions and more willingness to lean on capital markets or policy support. If you start seeing explicit targets around free cash flow, ROIC, and GAAP profitability, that's your early signal of a discipline pivot.
Let me circle back to that trivia. I asked, which year did NIO's US-listed shares hit their all-time peak? And roughly what price range did they spike into? 20s, 40s, or 60s? The answer? That blow-off peak was in early 2021, and the stock ripped into the $60 plus range before gravity and fundamentals reminded everyone they exist. Why does that matter for profitability and the long-term bull case? Because when capital is free and the share price is mooning, you can fund losses, build swap networks, and chase every growth angle. In a world where the stock is nowhere near those highs, investors aren't paying for vibes, they're paying for cash discipline. The bull case now isn't, we'll go back to $60 just because we did once. It's, can NIO turn all that 2020-2021 spending, plants, brands, software, energy, into a business that throws off real, repeatable cash without needing another hype cycle?
So, revisiting the big question, is NIO profitable, yet 2026? If you're thinking like an institutional investor, the nuanced answer is 2026 can plausibly be a year where non-GAAP operating profit and segment profitability look decent on paper, especially if volumes ramp, swap utilization moves closer to the sweet spot, and software and services keep gaining share. But the real inflection, the point where GAAP earnings and free cash flow are consistently positive and less subsidy dependent, probably looks more like a 2026 to 2027 journey, not a single victory lap quarter.
What has to go right? Cost per vehicle and per swap keep trending down. The gap between GAAP and adjusted margins narrows instead of widening. Operating cash flow grows without relying on working capital stunts. Energy, services, and software become a meaningful slice of revenue, not just a line in the dreams section. And NIO survives the next round of price wars without surrendering its brand or its balance sheet. Hidden metrics to track: swap utilization and station count versus active park, revenue mix from energy, software, services, gross margin by brand, if they ever give you that color, and cash burn per vehicle over time. If those lines keep bending the right way, the long-term thesis has bones, not just branding.
If they don't, if cash burn per unit stalls, swap stays underused, the GAAP, non-GAAP gap widens, and policy support does more of the work than real economics, you've got your answer, even if the headlines stay upbeat.
Before we wrap, quick full disclaimer. We're not financial advisors, and this show is for educational and entertainment purposes only. Nothing here is investment, tax, or legal advice, and nothing is a recommendation to buy, sell, or hold any security, including NIO. All opinions are based on information we believe is reliable as of recording, but that can change, and we might be wrong. You should do your own research, read the official filings and risk factors, and if you need personalized guidance, talk to qualified financial, tax, or legal professionals who understand your specific situation. Investing in equities, especially single stocks, foreign-listed names, and volatile sectors like EVs, carries significant risk, including the possible loss of your entire investment.
Take care of yourselves, take care of your capital, and don't outsource your brain to any podcast hosts, including these two. Simon, this was fun.
Always. Love digging through the messy footnotes with you, Layla, and thanks to all of you for hanging out with us. This was the pilot of NIO Investment. There's a lot more to unpack, so we'll see you in the next episode.
All right, we're going to land this. This episode of NIO Investment asked, is NIO profitable yet 2026? And the grown-up answer is, maybe in the adjusted headlines, but the footnotes and the cash flows are where you earn or lose money. Thanks for digging into the messy part with us, Simon.